On the show now is David Lennox, analyst at Fat Profits. David, I thank you so much for joining us. I want to start with the crude oil prices, where another week starts, and while there is a profit taking, we are off 10-month highs on crude oil prices, but it still is trading above $90 a barrel. What's the sense that you have on prices?
Oh, look, there's no doubt about what we've seen in the markets is the fact that OPEC and Russia have extended their production cuts that were supposed to end. The markets were expecting to see those cuts only go out to October, but they have extended them through to the end of December. That did take the market by surprise, and just that extra production not coming on stream over the next couple of months has caused enough concern that there will be a supply shortage, and we've seen the oil prices rise accordingly. But one has to look at what probably is happening more broadly. We think that the oil prices should have, with this sort of announcement, reacted much more sternly, but they haven't. So one would suggest that the markets are still somewhat sceptical that there is demand destruction still potentially floating around.
So, David, with with that fundamentals in hand, what's your sense on prices? Because various banks and brokerages have now raised their crude forecast to 90, 95, even 100 for some of them.
Look, at this stage in the short term, we're expecting crude to probably hold somewhere around $90 to $95. We do believe that when you have a look at the longer term, that OPEC doesn't want to lose the pricing power that they now have yanked back off the Americans. And that they did quite well through the course of the last couple of years by driving US shale production out of the market. So we believe that if they head it towards $100, the marginal cost of production in the US is improving, and that might see US production return. We think they'll be very comfortable between $90 and $95. That will keep the US out of the market and keep OPEC in control of prices.
All right. But your point is well taken. Also, India and US, both of these countries are headed for elections very soon, and their interest would be in seeing prices lower.
It's difficult to tell, but all one can say is that OPEC have promised to sustain the production cuts for longer. Of course, it'll only take them coming out one afternoon or one morning and suggesting that those production cuts will be actually implemented and taken away, and we'll see the oil price retreat quite quickly. At the moment, the market is focused on the fact that production is being held back. But as soon as there's news that that's going to change, we will see the oil prices falling. Demand isn't, as far as we're concerned, that strong to suggest that the prices, are being led by a demand push. We do think it's actually being led by a supply holdback. And if you change that holdback, the whole picture changes.
How would you look at the gold and silver prices also? Because, rising crude oil prices means concerns about inflation, but we also have the dollar index trading at around 6-month highs, and we have seen profit taking in gold silver from its highs. From here, where do you see prices?
Look, we've been a bull for the gold price for some time. Unfortunately, it's been the US dollar that's caused our call at this stage not to bear fruit. That's because the US dollar and interest rates have moved in the favor of the US dollar. The interest rate differential has narrowed, and that's caused the US dollar to rise. So look, overall, we remain bullish on gold. We do believe the US dollar does have to at some point fall. Those interest rates can't remain the interest rate differentials can't remain in favor of the US dollar forever. They do have to narrow, and we expect sometime through the rest of this year and certainly into next, that's what's going to happen. And that will be a very good tailwind for the gold price.
All right. So you're bullish on gold and silver, but what's your sense on dollar index itself? I mean, you don't think it will hold at these levels, but we have seen dollar index trade at a 6-month highs. We've seen 8 weeks of constant gains on this one.
Yes, and certainly this is where we've got our call wrong so far, and that is the US dollar and the US dollar index has kept moving higher, albeit not at a significant pace, but it's been enough to keep commodity prices and any rally in check. We, as I've already said, we expected the dollar index would be falling, primarily because of those interest rate differentials. But every time we've expected that to happen, unfortunately, US interest rates have risen, and that's pushed the US dollar into a more favorable position, and the index has risen. So we are watching very closely. We're not going to change our call at this point in time. We think the metrics are in place, except for those interest rate differentials. When they do change, the US dollar will definitely come off, and that will be a very, very good tailwind for the gold price.
Okay, David as well as Manisha, thanks very much for taking us through that conversation. We need to take a